Welcome to We Chat Divorce. Today, Catherine and I welcome Karla Kyte, branch manager and originating loan officer at Cross Country Mortgage based out of Denver, Colorado. Welcome, Karla.
Thank you so much for having me.
Thanks for being with us. So, our episode today is pretty exciting because it's so relevant to so many divorces. It's all about the property split, mortgage solutions for divorcing couples. In this episode, we're going to dive into the complex world of handling home equity and mortgages amidst the challenges of divorce. But first, let's meet Karla. Karla is a certified divorce lending professional. You'll see the initial CDLP after her name. She focuses on helping divorcing homeowners make a more informed decision regarding their home equity solutions, and the divorce team identify and potential conflicts between the divorce settlement, the mortgage, and the real property. Karla has 25 years of experience and brings a personal touch to the guidance she provides her clients, having gone through her own divorce. So again, welcome, Karla. We're really looking forward to our discussion today.
Thank you. Thank you so much.
It's a good thing we don't have a hotline right now because this is the hot topic and we would be inundated with phone calls.
Yeah,
So
I can.
true. So Karla, we mentioned that you went through your own divorce, and I'm guessing that that had some um, reason why you are doing what you're doing today, the good work you're doing today. So can you share a little bit about your story and how you have arrived here?
Yeah, absolutely. So first of all, and I honestly didn't even put this together until very recently, but I got into the lending business due to going through divorce. So I didn't really have a career path. I didn't know what I was going to do, how I was going to financially raise my children and take care of myself. And I fell into lending. So that's how I ended up as a lender. But then for many years, I couldn't figure out why we were constantly dealing with things written into separation agreements that couldn't possibly be done. And it was really frustrating because people would come to me, mostly women, in tears because they had agreed to refinance in a certain time frame and then they weren't able to do it. And so it was super frustrating. I was like, I don't understand why attorneys don't come and talk to us first. Like, we're the lenders. We kind of control this time frame of when we can do a refinance and so on. And so I had expressed my frustration to a mediator, and she said, well, do you have your CDLP? And I didn't even know what that was. It was a fairly new certification at the time. So this was in 2017. And I didn't. So I went home and I researched it, and I found that the next certification class was in Arizona. But oddly enough, the woman who ran the Divorce Lending Association was right here in Denver. So I hopped on a flight to Phoenix. It was a 2-day course. And I honestly thought, you know what? This is going to be so easy. I'm going to work the whole time I'm there because I'm super busy and I know what I'm doing in lending. So I'm just going to pop in, get this certification, and pop out. And then I'll have all these people that will want to work with me. And I was really pleasantly surprised. I think I was 30 minutes into the class and I shut my laptop and I was fully engaged in the course because I just didn't know what I didn't know. I knew how to be a lender. I didn't know specifically how to be a really good divorce lender. So I've learned a lot. I've had my certification since 2017. We have helped over 1,000 families with their home ownership in the last 5 years. Not all divorce, about, I would say, probably 15% of those were divorced. So we've helped a lot of divorcing couples figure out this path to remaining in home ownership.
Boy, that resonates with me. That's when I became a CDFA, kind of the same
Yeah.
story. Yeah, it's great. It's the knowledge that's really needed. Like I said earlier, it is the topic when you're trying to do division scenarios.
Yeah.
Yeah. And this area of divorce, lending, refinancing, it, fits right into preparing for divorce. And a lot of people just don't take that step because historically it wasn't even a known step. But, at My Divorce Solution, we really talk to our clients about all of the different areas of where they need to prepare. And this is really one of the most critical ones because, to your point, why don't divorce attorneys or mediators or anyone else say, go figure this out? And I think maybe on some level, they'll say, you want to see if you qualify just generically, but
Yeah.
people don't know what that means. They don't know what questions to ask. And so, in that space, and especially in our post COVID world, where so many families have that 2.5% or 3%
Mhm.
mortgage, what are the things that they should be thinking about when one spouse or the other wants to retain the home? They're considering refinancing. Words like assuming the mortgage or, flying around, refinancing. How should people break that down? And what questions are best asked when they're faced with this?
Yeah. So if one person adamantly wants to keep the marital home and they are in that low interest rate, and believe me, there's a lot of them, I think there's two big things. So the first thing is to assume the loan, you have to fully qualify. So not everybody realizes that. They think that they can just quit claim the other person off of the title, but to actually assume the loan, you have to fully qualify. So there's a lot to plan for there. If you need any support, any of your maintenance support to help you qualify, you have to plan for that because you have to have received it for a certain period of time before you can even apply to qualify. And the other big problem with assumptions is that they take a very long time. So somebody like me, like I'm an originator of new loans. I don't handle assumptions. My company handles assumptions and
Mhm.
servicing companies handle assumptions. So you're not working with a lender like me, you're working with a corporation. And I've heard nightmares about the timeframes that assumptions take. I have an example of a woman who, in her final divorce, it was final in late summer, early fall, and she agreed to have her husband's name removed and her to assume the loan by the end of January. It didn't happen, and now he's forcing the sale of the home. I don't know if he'll win that, but that's what she agreed to, and she couldn't get the assumption finalized. So that's the biggest problem is you have to understand that time frame and that you have to requalify to assume the loan. The other big issue is how are you going to settle the equity buyout? Because you can't pull out money in an assumption. You can only assume the loan in its original terms. So if you have to buy out the other person, how are you going to do that? And there's a lot of different ways that you can do that. I don't know if you guys want to dive into that or
I wanted to specify something about the language and the client that you brought up, which is really so frustrating and unfortunate. It's because of the attorney's role in protecting that language. So
Mhm.
even if she not even if, but if she was not able to assume it because she couldn't qualify because husband missed a alimony payment or support payment. So it told the banking industry, okay, we need 6 consecutive months of the same deposit happening. So where's the language to protect that woman if in fact she wasn't able to assume it because he missed a payment? Because that makes
Very
them
good point.
start over counting again, right? And if
Yeah.
there's no language to protect you in your agreement, yeah, there's the force of the sale of the home.
And so that right there that right there is exactly why we all have to work together, right? And come up with what is the best solution in the language. In the case of the woman I was just talking about, she simply couldn't get the bank off their butt to get it done, right? So
Mhm.
that was the problem, but I can see what you're saying. That could be a huge issue, and
Right.
no protection for her.
And I don't know if I heard you right, Carla, but were there even 6 months in that span for her to demonstrate to the bank that, if that was relevant to her qualification? Sometimes we see in agreements they have 90 days to refinance, but 90 days doesn't cover that prerequisite from the
Right.
lender, which a person wouldn't even know. They wouldn't even
I know.
realize if they hadn't done that exploration. So, in that space, can people pre-qualify for an assumption? Do you know?
Well, I think that's where we would come in as
Okay.
working with them because I think they need to understand the reality of can they qualify or not. And just being told what it is that needs to happen, what has to occur for them to qualify, so
Yeah.
that's just where it's really important that you are working with a CDLP from the get-go. I think a lot of people think they don't need to loop us in until their divorce is final, and that's like the worst decision ever, because then we have to go back and ask for modifications. But, if we're looped, I always get that. Well, it's really early on, we'll call you when we're ready.
Well, that's another funny point. We hear this all the
Yeah,
time. So we have our considerations report, right? So for every debt, this would be a consideration, so that they should go to you and discuss all of this. But I love when you see, I don't love, I should say, I'm being facetious about attorneys when they say in the agreement, you'll just handle this later after your divorce is final. It's like, okay, these two parties can't communicate during the negotiations. You really think they're coming back to the table after it's all signed to
right.
talk about this, right? So yes, do this beforehand to make sure it's properly written in your agreement.
Yeah. Early on. I mean, I'm with people throughout the entire process. And, sometimes this process is a couple of years. So, it can be
Yeah.
very lengthy.
That's
Hmm.
so true. And Carla, from the space of people trying to determine if they will negotiate an alimony buyout or what the alimony would be, that all plays into their ability to refinance or assume the mortgage. Is that correct?
Absolutely. And this could be I mean, it is a huge factor in their qualifying. So, I mean, gosh, my head just spins when I'm having conversations like this because I have so many scenarios. Prior to November, we could do a lot with a lump sum settlement in lieu of monthly payments. But Fannie Mae made some really, really big changes around their guidelines. And when we get a lump sum settlement, we often can't do near what we could with it before. So it makes qualifying even more difficult now, after the November 2nd deadline.
Just
So,
to, yeah, just to clarify, you're talking about a lump sum alimony maintenance buyout, right? Not a lump sum
yeah.
equitable distribution, right?
Yeah, yep. So we used to be able to take that lump sum distribution and set up a trust and create money, a monthly income cash flow from that trust to help them qualify. But Fannie Mae put the kibosh on that, so we can't do that anymore.
You know what? It also brings us down to another really good point when I just um, thought of is that even if you're negotiating to keep the home, so you're negotiating away another asset, that will throw off your income to debt to asset uh, um,
Ratio?
ratio. Thank you, Karen.
Hmm.
Right? Because you won't have as many assets, or would that not matter?
Kind of. A lot of people kind of mix up asset with income when it comes to our debt to income ratio. So we have to be really careful of that because a lot of people think, oh, I'm getting this massive settlement. I'll be fine. I can qualify for whatever. Not true. We don't care about your assets. We care about your income. And the reason why is because after the housing crash, there was a bill that was signed into effect. It's called ATR, ability to repay. So we can no longer look at assets and equate that to any type of income. It has to be qualified income that's used for them to qualify. And something I want to put out there too is that, yes, if you have a big pile of assets, I can probably find some loan for you. It's not going to be the best loan. It's not going to be the best terms, right? I can probably find something. But if you don't like the interest rates as they are today, you're not going to like that loan type either. So that's really my goal is how do we get these people into, reasonable loans like the rest of us get to qualify for every day, right? Instead of some of these crazy asset loans, where the interest rate is typically 2 to 3 points higher.
Yeah,
No, that's a lot.
Yeah.
it is. Carla, is it easier to refinance versus just securing an original loan, like on a new residence? Or is there any differentiation there relative to their approval process?
No, there's no difference.
Mhm.
So whether you're qualifying for a new home or, to keep the marital home, it doesn't really matter. The assumption process is much longer than a refi. Like we could do a refi in 2 to 3 weeks. The assumption process is going to take much longer. But I understand if people are, wanting to stay in a 2.5 interest rate, that totally makes sense, right?
Mhm.
But qualifying for a new home or the current home is the same, not an issue. And depending on what state you're in, like here in Colorado, I can easily before the divorce is even final, I can easily get somebody into a new home if that's what their goal is. So I do a lot of that with the people in Colorado because we have a 90-day wait period. And a lot of people don't want to stay together in the marital home during that 90 days. If they're super amicable, I can usually help one of them get moved along into a new home.
Oh boy, here come the phone calls again.
I know, it's
Nobody
so
wants out.
important.
Yeah.
It's so
Get me
true.
out. However you can get me out, get me out.
Right?
Well, it really is the first asset that most people are talking about dividing,
Yeah.
right? It really is front and center. Who's keeping the house or what are we doing with the home? So, because it's front and center, what do you recommend someone do immediately out of the gate? And in we call it the preparation process, right? Before you start negotiating, what do people need to do and consider with you? And what do they need to have in hand for you to be able to help them?
Yeah. So, I mean, we definitely have to have an initial phone call. I need to know what their goals are. Like I said, a lot of times, especially with women, I want to keep the marital home no matter what. That is the most important thing to me. I want to keep my kids in their home, and then when we start actually going through the reality of that and the real numbers of that with today's market. And what I mean by that is not only the higher interest rates, but most people have had a considerable increase in the equity of their home. So when they find out what they have to actually do to buy out the ex-spouse, and they find out in the end that that new payment that they're going to have means that they can barely put food on the table and they can never go on a vacation again and they can't do anything fun in life ever, sometimes they change their mind, right? So it's really getting with them and helping them to figure out what is their goal, because I think their goals change once they see some reality. And then I have to have them apply. I have to go through the application process because the other thing that comes up is sometimes there's some credit stuff they're not aware of, but credit's usually people usually know what their credit is. The big issue that we see is with their employment and their income, especially if they've been a stay-at-home mom for a certain period of time and they're newly back to work. We need to know, can we actually use this income, for you to qualify? Is it qualified income? I had a lady in the fall who on paper, she looked great. Her application looked great. As soon as we started gathering documentation, we realized that she was never receiving any of the maintenance that was agreed upon, even though her divorce was finalized 8 months ago. They were amicable and they made an agreement where he was continuing to pay all of the household bills until the marital home sold. So instead of paying her maintenance monthly, he paid all of the bills monthly. I couldn't count any maintenance and she needed it to qualify. So it's really, I mean, we've got to dig in really deep and make sure that the income can be used, their employment is usable for the loan program that they're under. And then, of course, if we're using maintenance or child support, we have to be able to show proof of receipt. You
I
know,
talk about that all the time. I mean, she actually can go back and say he never paid me maintenance because it was supposed to be in the form of a check. I mean, she can make his life a little bit miserable as well.
that
And
too.
yeah, yeah. So again, I always say get that monthly check, the way it's spelled out to be received in your agreement, just so everything is on the up and up and keep good track of it. But yeah, I've heard that before. It's again another unfortunate
Yeah.
situation.
It's when
Yeah.
people are amicable, I think, oddly enough, right? I don't think
Right.
anybody is purposely not complying with a court order. I don't think they realize that either. Like, this is a court order.
Right.
Yeah.
um, but when
Well,
they're amicable, they just kind of go, they get really, really loose with their finances when they're amicable.
That's true. And you know what? The attorneys go along with that and not from any other place than, well, if it's working, why spend the money to get temporary orders, right? Well, you wouldn't even need temporary orders. But I think what we're all saying here today is even before the divorce, if one spouse is renting and you're in the marital home, a lot of people will just settle for, well, these expenses are being paid by this person and these other expenses are
Mhm.
being paid by the other person. Often when I'm on the phone with an attorney, I'll say, well, isn't it better to start establishing a dollar amount per month? In some cases, it's not, especially if the spouse is paying way more than they would be exposed to. Catherine can talk more about this, but in cases where certain expenses are being paid, to the extent that that can be in the form of a check, and then that spouse paying those expenses,
Mhm.
that does start some cash flow to the spouse who hasn't historically earned income.
Right. So when they do that, we need temporary orders in place and we need to track those payments. And then we can start using it for qualified income. It's great when that happens.
Mhm. So let me just ask about that, Carla. If they don't have temporary orders in place, if they have some kind of financial agreement, a stipulation, or whatever, would that qualify as well? Or do you need that converted into an order?
So it's a gray area, I'll be honest with you.
Mhm.
Um, I mean, I the only time I've ever used temporary orders, it has been actually put into place. Temporary orders are put into place.
Mhm.
But I've heard, can they be written down on a napkin? We agree to this temporary order. I've heard that that's useful. So I think if that's in place and you can show proof that that money has been moving from party to party on time every month, it can be used. Here's the other big caveat there: it has to come from a separate account. So if they're moving money from a joint account to a joint account or from a joint account to an individual account, can't use it. So they have to establish individual accounts when they're doing this temporary order situation, or we can't use it. That's a big one. That's a big problem. Even oddly enough, after the divorce is final, we run into that. We run into people
Mm,
still having their joint account open that they're just funneling money back and forth through. Can't use that.
A
that's
good
so
tip.
interesting.
Very good tip.
Yeah.
Mhm.
Yeah.
So I have another question for you, Carla.
Mhm.
A lot of people are receiving child support. Are there child support um, payments? Are they qualifiers for mortgage eligibility in addition to spousal support?
Yes, absolutely. So, again, child support, we have to show proof that it's been received. It depends on what type of loan. FHA only requires 3 months. Conventional Fannie Freddie requires 6 months. So we have to show 3 or 6 months receipt, but then it has to continue for 3 years past the date of there's two different deadlines, but let's just say the closing of the loan. So, if the children are 16 and 17, we probably can't use that because
Mm,
it won't be received long enough and continue long enough. But one of the things too about child support is that you can actually gross it up because it's not taxable income. So it will actually count for a little bit more than just its face value in a mortgage qualification. So that can be really helpful with, the increased rates and cost of housing today. That can be helpful for sure.
Well, then can you gross up alimony, which is not taxable? That's good to know.
Yeah, yeah. We have another interesting little a little trick that and this is stuff that, like, if you're not working with a CDLP, your typical lender is not going to know half of this. And I'm not kidding. Like,
incredible.
yeah, I mean, I am 100% into divorce lending. My team handles anything else that comes our way. My daughter is actually my partner. She's also a CDLP, but she's 29. She wants to deal more with people moving up and investing and so on. But so one of the other things that we're able to do, and this is under a Fannie Mae guideline, if you have somebody that's paying the spousal support, this goes for maintenance. Instead of counting that against their debt to income, and Catherine, you'll, I think, understand this maybe a little bit more, but instead of counting it against their debt to income, like a car payment or anything like that, we can deduct it from their income. And so we'll start at a lower basis for their income, but it will allow them a higher debt to income ratio for qualifying.
Hmm.
Only CDLPs know that.
Mm-hmm.
And I will say a lot of lenders, a lot of underwriters won't sign off on that. So that's definitely one of the things that before I came to Cross Country Mortgage, I had to go to the underwriting department and make sure that they understood truly all of the guidelines that we have to deal with our divorcing clients. And that one right there is a big one. I had to fight hard for that one
Mm-hmm.
because it kind of doesn't make sense, but it is a Fannie Mae guideline.
Yeah, so I'm cautioning you, if you're listening to this, this is where I like when you get this knowledge for yourself and you're yourself only, because I could just see what happens in negotiation. It brings us back to prior to 2019, where people want to negotiate off different incomes,
Mhm.
because they're saying, you're really grossing up more than this. That's why I'm not going to give you this, or they take it all the way down. So this is really powerful information for you to have behind the scenes so that you can negotiate making smart decisions. So I'm glad you brought that up.
Yeah. Yeah. Do you guys mind? Can we talk a little bit about the equity buyout part of it?
Do
'Cause
it.
I touched on that earlier, but I do want to make sure we address it because I think that's also one of the big problems. Like I said, in an assumption, you can't pull out any money to buy out the ex-spouse. So when you're negotiating that and you're planning on assuming the loan, but the only way that you have to pay off your ex-spouse is to take out a home equity line of credit, you have to really, really understand that time frame that you're negotiating with your ex-spouse. Because if you need, and this is like worst case scenario, let's say that you need 6 months of the maintenance to qualify. So you don't start getting that until the divorce is final, let's say. So then you're already 6 months down the road before you can even apply for the assumption because you need that money to qualify. Then you're another 6 months in for the assumption process. So now you're a year out from divorce because you can't get that HELOC until after your assumption is done. So you're not going to be able to pay off your ex-spouse. Could take over a year before you could pull that home equity line to pay them off. And you have to qualify for that too. So just I think having people understand that time frame that it could take, and it might be well worth it, but you just have to understand the time frame that it could take. Now there's other ways to negotiate that buyout, right? You can roll other assets, to negotiate that, which is fine. But then I think you also need to really understand what it is that you're after. I have a woman who she was told, no matter what, do not lose your interest rate. She's at 2.75. And so what she was negotiating with her ex-spouse was to give him her entire retirement. She is self-employed. So now she has no retirement. And for the next 5 years, she's paying him $1,250 a month. And when we looked at her cash flow, it was her monthly cash flow was the same as if she was just to do a refinance and get him off of there. Right. And then she
Yeah.
wouldn't have lost her entire retirement either.
Well,
So,
Carla, that's another great point. And again, at the teams at MDS, when they work with our clients, it's really important that the process of getting prepared and knowing those considerations, because what else, in addition to what you just said, yes, they could have got off, but when you negotiate that retirement account away, if you're 50 or older, and I'm even going to venture to say 40 or older,
mhm.
having a lump sum of money is very hard to come by. So what you have to save on a monthly basis to catch up to a lump sum payment, the growth of that, the market's up over 20% this year, right? So with the growth that 20, I'd rather pay a 5% mortgage rate than give up a 20% growth rate on a tax deferred investment, because
Right,
net, where are you going to be better? You'll be rid of
right,
your spouse. You won't have strings attached anymore. And you'll also have another investment that's growing at a better compounded rate, and of which you could take that growth to pay off that higher mortgage maybe 15 years from now, even if you get a 20 year. There's so many things that you can do. And again, having a CDLP like you to talk about what needs to be included in your agreement, and getting organized through the MDS process gives you that opportunity to make really smart decisions for yourself.
Right. And that's where we work together. I mean, believe
Right.
me, I love CDFAs because I feel like we share a brain. Um and it's hard these days, I think, to show people and help them to understand that that mortgage rate that they have in the low threes or high twos is not always their best option. I mean, but man, they hold on tight to those.
Yeah.
Yeah, that's so true. And Carla, I think a lot of people, just to your point of getting that singular assessment, it's really important that people prepare from a holistic approach, right? Like Catherine was saying,
Yes.
these are all of your marital assets. This is all of your community property or whatever state you're living in. This is it. And based on what you think you want, the home or the retirement account or whatever it is, this is the financial impact. And then from there, if you still believe that this is most beneficial for you or it's worth exploring, then you go to these professionals to further explore what that would mean to you. So I think to your point, a lot of people say, well, I just want to keep the house. I just want to keep the house. And then they have their entire team working on keeping the home and what that means to them with complete disregard to the rest of the marital estate.
Yeah.
Or maybe not even complete disregard, but at the end of the day, it's your client and you have to follow their request, right? You can't challenge them too much. But that is the beauty of the MDS financial portrait is our clients are already aware holistically of what they're able to explore or want to
Mhm.
explore. And then from there, then get more information. And I think that creates a world of difference from what most people experience going through the divorce process.
Yeah, I think just being aware and also knowing that your divorce is not your girlfriend's divorce, it's not your mom's divorce, it's
Mhm.
your divorce is your unique divorce, and you can't just get advice from social media or your coworkers or your friends and family because they don't know your whole situation. Like you've got to rope in the experts that will look at the whole entire picture, right? And be able to
Mm.
maybe make some better suggestions, or maybe not.
Yeah.
Sometimes they're right.
Absolutely. So, Carla, we could talk about this on and on. I
I
know.
know.
Uh, so many things.
For
And so
days.
I appreciate you being here today. This is so valuable
Thank you.
to probably a very high percentage of divorcing couples. So, how can our listeners find you and learn more about you?
Absolutely. So Karla Kyte, I'm in Denver, Colorado. You can reach me on email at karla.kyte@ccm.com. Or you can call or text our phone number. It's 303-525-9077.
Excellent. So, this concludes our discussion the property split, mortgage solutions for divorcing couples. Thank you so much, Carla, for a great conversation.
Thank you. Thank you both.